In this video, I will comment Fundsmith's annual letter to shareholders for 2024. This is this document. This is 12 pages. And what I will do for this video is I will read through the text. I will comment on what I see because I've been following Terry Smith and Fundsmith since inception. I've read all their letters. I have a wallpaper of Terry Smith in my room, which means I love this investment style, and recently the performance has not been great, so I have not read it yet. So we will see the results. You will see what they say. You will see the future prospects, what they have sold, what they have bought, and how they see their portfolio at the moment. And Terry Smith has a lot of critics regarding his investment style, especially regarding valuation. So you will have my opinion if you care about the situation at Fundsmith. So we can start. If in case this is your first video from this YouTube channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year, investing in stocks very similar to Terry Smith from Fundsmith. So where should I put my face? Here, let me zoom in. Let me start. So this letter was released in January 2025, and they show the performance that they had in 2024 compared to the index. Okay, so they have made a gain of 9% for Fundsmith compared to equities of 21%. This is not, equities is not the S&P 500, it's the MSCI World Index. First page, I see some critics. I have read some people criticizing this benchmark, because if you look at the portfolio of Fundsmith, mostly US holdings, mostly US companies. So why do you compare yourself against the MSCI World instead of comparing yourself to the S&P 500? So the critics start at the at the first paragraph. Okay, so anyway, and if you compare this with the inception, I mean, inception was what, 2010? Yes, since inception in 2010. Since inception, the fund has generated a performance of 15% per year compared to equities, so the MSCI World, of 12% per year. And if you compare this with the S&P 500, maybe the S&P 500 is around 14%. Anyway, this is still an outperformance compared to their benchmark, compared to the S&P 500. I think they still outperform the index. I will have to double check, but this is still a very good performance. I mean, 15% per year, this is amazing. And they compare themselves with the global sector. UK bonds, yeah, obviously cash yields a lower return. Okay, let me continue. The performance was 9% in 2024. This compares with 20% with the MSCI World Index. The fund therefore underperformed the index, but on a longer perspective, we have outperformed with a better Sortino ratio, Sharpe ratio. To be honest, I don't want to know what the Sortino ratio, Sharpe ratio means. I mean, everything mean. I just don't care. And this is not the way I invest, so I will just skip this part. The fund is the second best performance since inception in 2010 from a lot of funds, and has delivered great returns over the long term. Outperforming the market or even making a positive return is not something you should expect from our fund in every year or reporting period. This is very correct. This is right. And outperforming the market was more than usually challenging once again in 2024. Yep. They have made some investments in 2022, 2023 that were in a bad situation, and these companies are in an even worse situation right now in 2024, 2025. Just 5 stocks, the Fab 5, like Nvidia, Apple, Meta, Microsoft, and Amazon, provided half of the returns of the S&P 500. Yes, 2024 was very challenging for funds, for stock pickers, because all the alpha can be evaporated, and all the gains from your benchmark, the S&P 500, all the gains are caused by a few companies. So that's very frustrating. And if you don't invest in Nvidia, Apple, Meta, Microsoft, Amazon, you just underperform. That's very easy. You have some stocks here and there. I'm thinking of Texas Pacific Land that outperform everybody, like doubled or tripled. Vistra Energy doubled or tripled. That's wonderful. But globally speaking, it's very hard to outperform the market. You need a few pockets of undervalued businesses. This is similar to the concentration of returns provided by the so-called Magnificent Seven in 2023. Yeah, basically 2024 was the following year of 2023. No major political change, no major change in earnings. Moreover, a single stock, Nvidia, produced over 20% of the S&P 500 returns in 2024, which is amazing. I mean, if you look at Nvidia's performance, it's plus 150%. Like from January to December, yes, plus 130% gain. That's for a company of $3 trillion, that's amazing. Nor is this concentration of returns in a few technology companies a purely US phenomenon. In Germany, 41% of the return from the DAX index come from a single stock, SAP, the software company whose share price rose by 70%, and it's trading at a very high valuation at the moment. Most of the audience from this YouTube channel are from the US, so let me tell you more about the DAX. DAX 30, that's the equivalent of the S&P 500, but in Germany. And now, as I'm recording this video, they reached all-time highs. And Terry Smith is saying that there is a large concentration in this index, especially with tech. Yeah, the world is moving, and all the tech companies are quite expensive at the moment. Our fund owns some, but not all of these stocks, and it was difficult to perform even in line with the indexes unless you own them at least in line with index weighing. Yeah. Let me continue. This is the worst performance for the index. L'Oréal. What was the performance of L'Oréal? That's our French makeup company. L'Oréal, wow, you have a loss of what, minus 20%? L'Oréal is a famous compounder. If you just buy it and wait 30 years, you will be fine. But in the short term, you see some fluctuations. IDEX, so it's about pet. It's a pet company that does like healthcare for pets, minus 20%. Same thing, it's a compounder with a short-term negative performance. Nike, well, you all know Nike. It declined 20% or more, 30%. Brown Forman, is it like a alcohol beverage company? Yes, minus 30%. Oh, wow. This is a large decline. By the way, speaking of alcoholic beverages, these companies suffer. These companies are in a bad shape. You have this, you have Diageo, you have some companies in France, they are down again. You have what? Heineken. My new generation, we don't drink, which is true. We drink much less than the older generation. I don't know if that's a generational shift that will be like this forever. I don't know if there will be a reversion to the mean. But if you are invested in an alcoholic beverage company, man, that's hard. Lower revenue, lower growth, lower earnings. And the last performer, one of the bad performers from the fund is Novo Nordisk. It's a Danish company from Denmark, and this is the whole index. The whole index from Denmark. If Novo Nordisk tumbles, all the index falls apart. And it seems like this compounder has stopped compounding because of one of their bad results. I mean, the stock was already up and then down flat, and in December they announced a new result from their medicine. I think that's a loss weighing medicine, and the results were good but not that good. So the markets were disappointed and the stock fell. Look at this. In December 2024, the stock fell 20% on that news. So the market loved Novo Nordisk at the first half of the year in 2024. The stock was up 40%, and then a complete decline. Sometimes that's the life. So, okay, these were the top 5 detractors of performance for 2024. What is the reason? L'Oréal was adversely affected by events in China, where the economy is struggling. Okay, how much of the revenue from L'Oréal is based on China? I don't know, maybe 1/3. I don't know, not sure of this, but you get the point. Like LVMH, Hermes, Estee Lauder, something similarly. I'm still at page 2. You look at this. Estee Lauder is also a makeup company in the US. A lot of the operations are in China, and guess what? The stock is falling apart. This is a horrible story. If you had invested during the COVID lows, you would have lost half of your money. Sorry, this is in French. The interface is in French. So makeup companies, Chinese companies are struggling. This is not the first time that a major economy it operates in has misfired, and we believe its management can cope. Yeah, L'Oréal is a strong business. IDEX, so pets, healthcare for pets. IDEX, which makes veterinary diagnostic testing equipment and supplies, is suffering from a slackening in the pace of vet visits after the scramble to adopt pet during the pandemic. Okay. As the industry leader in an area with real long-term growth prospects and a stock where we would probably struggle to buy back our position if we sold it, okay, we intend to continue holding IDEX. Okay, and try to smile through the pain of underperformance. Another stock that is in this industry of pets, if you are interested, if you have a dog, if you have a cat, is Zoetis. Zoetis is bigger than IDEX, and similarly, the results have not been great. The results have done nothing for 4 years. So maybe the Zoetis and IDEX are cheap. I don't know. I just know these are decent companies. Nike is interesting. Sorry. Nike is a stock we bought after the share price fall during the pandemic, when investors seemed convinced there would be many fewer buyers of trainers. In fact, Nike had made great strides in online marketing and fulfillment. What we hadn't realized was that the then management would parlay this success into a problem by ignoring the traditional brick-and-mortar retail channel. Oh yeah, which was recovered as the pandemic passed, and in so doing opened the door literally to competition. Yes, in the past, Nike sold their shoes through Footlockers, local suppliers of shoes like Footlockers. And the new CEO, that was a CEO that came from eBay and ServiceNow, I think. They had a new CEO in 2020, and they said, no, we will not go through Footlocker. We want to go and sell in-house, sell our shoes from our Nike website. It turns out that it was a short-term boost to revenue, more margins, more efficiency in the short term, but because they didn't work with Footlocker, other shoe companies collaborated, made more revenue thanks to Footlocker. And more companies, more competition worked with Footlocker, and more growth for this competition. So in terms of market share, this is maybe not a smart move from Nike. In terms of market share, they took a hit, and now the CEO was fired. There is a new CEO from Nike, so maybe they will start again working with Footlocker local suppliers. Okay, so more competition in this industry. To be fair, there have been other issues such as an increasing dependence on fashion and less on traditional exercise uses. However, the good news is that there has been a change of CEO this year. Yeah, late 2024. We see many commentators musing about the reasons why the US economy is so successful. Perhaps one reason is a quicker finger on the trigger when top executives do not deliver. Yeah, you have some activism in the US, which is great. In Europe, I mean, I take a look at my country, France. We have slow management teams. We don't have a lot of activism. We love dividends. We don't really know how capital allocation works. I see countless of examples, small caps and mid caps, with bad capital allocation. In the US, they don't hesitate to have some activist investors, which is great for capitalism. In which context we note that Unilever's shares were up 20% in 2024, we await developments from Nike's new management, who have after all inherited what is still the dominant market share in the sector. Nike is still the leader. If you look at the top 20 brands of the world, Nike is here. I mean, they have the branding. Now they have a new CEO. They have a new management. The operations are fine. The shoes are fine. The competition is coming, but I mean, they still have good assets, good intangibles, and good branding. So they can pivot rather quickly. In 2025, Nike's situation can change a lot. Okay, now Brown-Forman, one of the world's top 5 drinks companies and the distiller of Jack Daniel's Tennessee whiskey, has suffered from the fall in consumption from the pandemic highs and is probably seeing early signs of the adverse impact of weight loss drugs. We sold our Diageo stake during the year, which I will cover later, but retaining Brown-Forman keeps a foothold in what has long been a sector with a good business characteristics and which has the potential benefits of family control, which can promote good long-term decision making and a larger bias towards premium spirits than Diageo, which may help obviate the impact of weight loss drugs. Drink less, but better quality. Yeah, not sure of that. It is a company which survived prohibition, so we hope there is literally something in the DNA that help with these adverse circumstances. Yeah, I mean, that's fine. The business will not die, but they will suffer in the future. If younger people don't drink anymore, you have like a demographic problem, but if you increase your price, maybe you can circumvent this problem. Now Novo Nordisk, and then we will move on. Novo Nordisk was arguably our most surprising poor performer in 2024. It remains the market leader in weight loss drugs, which it pioneered, and the year was marked by a stream of news about other conditions which these drugs treat effectively and label expansion applications which drugs regulators seem willing to approve. You have another company like Eli Lilly, and I think they have a better performance. Like when you do your medical trials, I think Eli Lilly in the US had much better results and the stock price didn't collapse. Yet, not only did the share price fall 10%, but it finished the year on a PE ratio half that of its nearest competitor, Eli Lilly. Yeah, Eli Lilly is expensive at the moment. In investment, it is always better to travel hopefully than to arrive, and there is certainly an arms race going amongst the drug companies to develop competitor drugs. This is a competitive industry. Everybody wants to make the magic pill that will force people to lose weight. This is the magic pill that we've been wanted for the years and years and decades and centuries. If you find this magic pill, you will be making a lot of money. So that's normal, and the competition will be harsh. And what is important for these drug companies is that it takes a lot of money, a lot of billions of investments to make this kind of drugs. So I don't think small companies, small laboratories, startups can be finding this new drug. Either Novo Nordisk or Eli Lilly or somebody else, like a big company. They have the means, they have the cash, they can invest massively to find this magic pill. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Okay, now let's talk about positive stuff, right? The top 5 contributors to the fund to generate 9%. Okay, Meta Platforms, I like it. Microsoft, yes. Like always, Microsoft has always been in these letters like a big performer. Philip Morris, so the cigarette company. Automatic Data Processing, which I don't know, and Stryker. I have a doubt, which I don't know if I know this company. For Meta and Microsoft, I'm simply going to repeat my comment from last year. Okay, Meta Platforms is amazing, and they have recovered really well. I'm sure this is it. What is funny is that in past letters from Terry Smith, like in 2022, everybody hated Meta Platforms, and they doubled down on Meta Platforms. They didn't sell a share, they invested more, and they held. And they mentioned in their letter in 2022 that this is the most hated stock we have. We've received a lot of emails, a lot of questions regarding our Meta Platforms position. And it seems like our most hated stock will be the best performer in future years. And it turns out that this is exactly what happened for Meta Platforms. Meta Platforms in 2022 was their most hated stock. And if you look at the performance in 2023, amazing performance, more than a double. And in 2024, amazing performance. They had a plus 70%. So maybe Terry Smith from Fundsmith, maybe he wanted to have a fund with only one stock, and that's the most hated stock of the portfolio out of the mother fund. Maybe he does it, I don't know, but that's something in the plan. You just invest in one stock, the most hated stock at the moment, and and you see the results in the long term after a few years. Now Philip Morris, that's the fourth appearance in the top contributors of the fund. You can tell when some things are right by the people who oppose them, the governments and dysfunctional health organizations who have set their stance against this. Okay, nothing big. On the right track. ADP continues its metronomic performance. It rarely shoots the lights out in terms of performance, but neither does it disappoint. Okay, what is ADP? Let me check really quick. So, in case you don't know ADP, you will have the information. ADP. Let me put Wikipedia on this. Let me put in English. American provider of human resources management software. Oh, okay. ADP, Guru Focus. Let me check the financials real quick of automatic data processing. The market cap is $100 billion. That's a big company. Big company in the US. Human capital management solutions. The margins are good. What about the growth? What about the revenue, net income? I'm using a website called Guru Focus in case you want it. It's completely free. Okay, let me check. No, I want to check the growth. Let me refresh the page. And if it doesn't work, I will move on. Look at this. This is the revenue in blue. Wow, this is metronomic, as Terry Smith says. Revenue up and to the right. Net income, same thing. They don't have a lot of debt. They generate some good free cash flow. Look at this in blue. And the ROIC is, wow, not that big. The ROIC is increasing, so I think that's all about volume. Okay, and they do buybacks. Green is buybacks. They buy back what? 1% of their shares, 2% of their shares, 1%, 1%. Yeah, they have a minimal buyback program, but every year it adds up, and that boosts the earnings per share. And the PE ratio is 30. Forward PE ratio is 30. So they don't expect to grow much in 2025. Oh, that's expensive. Okay, yeah, maybe you pay a high multiple because it's metronomic and it's safe and you are sure that the business will not collapse, but quite expensive, I would say. Okay, let's continue. That's for ADP, and now Stryker, which makes the fifth appearance, is benefiting from work on the backlog of elective surgical procedures which built up during the pandemic. Or maybe I want to check what Stryker does. Sorry if you already knew these businesses. I just don't want to continue without having any information about these ones. Stryker. Oh, what's the ticker symbol? Stryker stock is SYK. Oh, this one, SYK. And if I look at this company, what do? It's a market cap of $150 billion in the US. Designs, manufactures, and markets an array of medical equipment. Okay. And look at the financials. Revenue, wow, amazing. Revenue up and to the right. Net income, wow, is cyclical. They have a little bit of debt. I mean, they have what? $13 billion of debt compared to a market cap of $150 billion. Roughly 10% of the market cap is in debt. Look at the free cash flow. Here, cyclical but growing. They do some buybacks and then dilute the shareholders. In red, that's the dilutions. And the ROIC is not that big. Return on invested capital, ROIC of 10%. And the margins are very good. Oh, wow, the margins are very good. And the PE ratio is 40, forward PE ratio of 30. So they expect to grow in 2025. Yeah, okay. Good to know. Let me continue. Given the number of repeat appearances in our top 5 contributors, I am tempted to repeat one of our mantras, which is that you make money with old friends. Like Microsoft has been in this list forever. However, 3 of those old friends which have been repeat contributors were detractors this year, namely L'Oréal, which is true, IDEX and Novo Nordisk. However, if anything, I would regard this as a blip in their long-term record. Yes, and we intend to mostly patiently await a return to form. Yep, some of these companies have temporary issues, like Novo Nordisk. Like your trial was good, but not good enough, and the stock is dropping 20%. I mean, come on. But for L'Oréal, maybe this is not a short-term issue. If China doesn't rebound, if China continues to have a recession, I mean, this is like a recession in China. So if China doesn't rebound in 2025, maybe L'Oréal will not rebound in 2025. And then they continue their 3-step investment strategy, which I love and which I preach a lot. Buy good companies, don't overpay, do nothing. Now, second round of critics for you. It's been some years now that I've seen this kind of critics, people criticizing Fundsmith. They say that this is their strategy: buy good companies, don't overpay, do nothing. If you look at the price to free cash flow that the portfolio had at the beginning of the fund, like 2010, the price to free cash flow was cheap compared to the index. Okay, so this is true. Don't overpay, because this is a discount to the market. So if you buy good companies with a discount, a margin of safety, you will outperform. And this was the philosophy of the fund for the first years of the fund. But now, I mean, since 2010 to now, let's say end of 2024, it's been 14 years, and gradually the valuations of their holdings improved, increased. The free cash flow yield decreased. The price to free cash flow increased. So these are not cheap companies anymore. So some critics say, no, just don't overpay. It's not true right now. Look at this. We've seen ADP, we've seen Stryker. They have PE ratio of 30. And right now the S&P 500 has a PE ratio of 30. So maybe you are overpaying or not. I'm not sure. And other critics say that most of the outperformance for the past 14 years came from this multiple expansion, the valuation that has gone up. Because if you look at the earnings growth that were okay, but valuation is going up, so that boosts your whole performance for the year, and that boosts your performance as a global fund. That's the life as a fund. It's never easy, it's never simple, it's very complex and very hard. So that's the life. Maybe they will continue to do this in the future. Maybe the valuation will expand. Maybe the valuation will shrink in the future. Nobody knows. But I think what they want to say with don't overpay is they don't want to buy companies with a PE ratio of 50, PE ratio of 60. That is really egregiously overvalued. So maybe this is what they mean with don't overpay. Let me continue. As usual, we have the comparison of our holdings. Look at this, compared to the S&P 500 and the FTSE 100. Why do you compare with the S&P 500 and not the MSCI World? You have two benchmarks, and now they compare it with the FTSE 100. Oh, I have a lot of things to say. Okay, so let me first comment the figures. Now, if you don't know how to analyze this chart, you see that this is the past years since 2017, and you see the ROCE, return on capital employed, that measures efficiency, gross margins, which measures pricing power and maybe a moat, operating margins, which measures the efficiency of a business, like you want the higher the better, cash conversion, which is the conversion between net income and free cash flow. So you don't have unnecessary cost, working capital, inventory stuff. You just want to translate your bottom line to free cash flow, which you can use to do buybacks, dividends, debt extra. And interest cover, this is the debt compared to cash. In how many years can you repay your debt? How much free cash flow do you have compared to your debt? I think that this one, now that I say it, I have a doubt. Meaning that's how easily a company can pay interest on its outstanding debt. Okay, yeah. So the higher the better. It's a debt measure. Let me continue. And they compare. You see that the ROCE since 2017 was stable and increased since 2022. Okay. And if you compare to the S&P 500, they have the double of ROCE. ROCE is 30% compared to 16% for the S&P 500 and 17% for the FTSE 100, which is the UK index. Gross margins, because they invest in leaders with pricing power, the gross margins should be higher. In 2024, the gross margins for their holdings on average were 64% compared to 45% for the S&P 500 and 42% for the FTSE. Oh, I'm impressed by the FTSE. Operating margin, you have 30% for Fundsmith. That's the double of operating margins compared to the index. Cash conversion, you have as much of a cash conversion compared to global indexes. And interest cover, you have 3 times better. I mean, they are invested in Microsoft that doesn't have a lot of debt. They are invested in Meta platforms, which doesn't have a lot of debt. So you can be very secure in your portfolio. And what is funny is that now you compare yourself with the S&P 500 and not the MSCI World. And they also compare themselves with the FTSE because this is a UK-based fund. But the FTSE is not a good index at all. You have industrials, you have banks, you don't have tech companies, you have oil and gas. I mean, the FTSE is not a good benchmark at all. If you want to outperform your index, you put the FTSE and that's it. If you look at the FTSE performance, now we reached all-time highs. But if you look at the maximum, that's a very shameful return. Let's say it this way. Wow, because this is a slow-moving fund with slow-moving companies. And that's normal. That's the UK economy after all. I mean, that's the index allocation, etc. So obviously, these ratios are better for Fundsmith. In 2024, operating profit margins were higher. Gross margins are steady. What do you say? Moreover, if you own shares in companies during a period of inflation, it is better to own those with high returns on capital, and gross margins. Gross margins measure pricing power. So, what is the cost to make a product? For Apple, what is the cost of making the iPhone? For Adobe, the software license, the cost of making Adobe, I mean, that's almost nothing, which is the reason why Adobe has very high gross margins. The higher the gross margins, the better the pricing power. Consistently high returns on capital are one important thing, something we look at. The weighing average free cash flow grew by 14% for their companies. The free cash flow of their companies grew by 14%. Good. The only metric which continues to lag its historical performance is cash conversion. Yeah, the degree to which profits are delivered in cash. Yeah, I mean, that's fine. Come on. That's fine. 90%. Novo is racing to build a production capacity to supply enough of its weight loss drug Wegovy and finish the year spending $10 billion repurchasing 3 manufacturing sites. Maybe they will talk about capex with the Magnificent Seven. Oh, that's here. Capital expenditures for Alphabet, Microsoft, Meta, and Novo Nordisk. You have to build the GPUs. You have to build something with artificial intelligence data centers. Yes. By the way, if you want to benefit from data centers, quick tip for you: you can check other companies that are also a data center play. You can check Brookfield. They build infrastructure also for data centers. It's a Canadian company with an amazing management. Just quick tip for you. And if you want to be invested in data center future, you can invest in LandBridge. No, not that one. LandBridge. They own lands in Texas, and it turns out that they plan to welcome data centers. They have a lot of lands. They have a lot of water infrastructure. They have cheap energy. They can welcome the data centers of the future. This is a recent company that IPO'd in 2024, and the prospects of the company, the growth prospects are huge. Another company, if you want to benefit from AI data centers, is TPL, Texas Pacific Land. Similarly, they own some lands in Texas, and it turns out that to build some data centers, you need a lot of land, you need cheap energy, and you need access to water to cool things off. And it turns out that TPL and LandBridge have exactly that: a lot of lands, cheap energy. They have cheap gas in Texas, and a lot of water. Okay, let me continue. Whether this arms race produces adequate profits and returns for the amounts expended remains an open question to which I will return later. At least Novo is building capacity to produce a drug for which there is established demand and profitability, and in which it currently has a competitive advantage. Yes, the average foundation of our portfolio companies was like 1 century ago. The companies Fundsmith is invested in are very old in average. On average, that's very, very old, over a century old. The second leg of our strategy is do not overpay. It's about valuation. The weighing average free cash flow yield, just so you know what is the free cash flow yield, is the price to free cash flow, but you reverse the formula. So if you have a price to free cash flow of 20, you reverse the formula. That's 5%. If you have a price to free cash flow of 30, you reverse the formula, and that's the free cash flow yield of 3.3%. So, yeah, okay. The free cash flow is generated as a percentage of the market value. Yes. At the outset of 2024, the free cash flow yield for Fundsmith was 3% and ended the year at 3.1%. So that means the valuation was decreased. The price to free cash flow decreased a little bit. So it became a little bit cheaper from the beginning of the year to the end of the year. And the year-end median free cash flow yield on the S&P 500 was 3.7. That means cheaper than Fundsmith. Right now, the S&P 500 is cheaper than this portfolio. Yeah, this is why you have critics. I mean, yeah, do not overpay. Yeah, this is the reason you have critics. You are more expensive than the index and underperforming. Well, quite bad. That's normal. That's the life. We will see for I'm very curious to see the valuation for 2025, by the way. Our portfolio consists of companies that are fundamentally a lot better than the average of those in the S&P 500. I couldn't agree more. So it is no surprise that they are valued more highly than the average S&P 500 company. I disagree. You can have beautiful companies trading at a lower multiple. Look at this now. You have Meta Platforms now trading at a PE of 25. Google, Alphabet paying at a PE ratio of 25. You have all the key companies in the US trading at a PE ratio of 15. You can get beautiful companies with better ratios and at a cheaper valuation. So, yeah, not convinced here. In itself, this does not necessarily make the stocks expensive any more than a lowly rated stocks make a stock cheap. Yeah, I agree. However, we expect some of this disparity in valuation to be eradicated in 2025 if, as we expect, the cash conversion of our portfolio companies improve. How can the cash conversion of their companies improve? Meta Platforms will have more capex. So the cash conversion for Meta Platforms will not improve. For Google, Microsoft, Nvidia, all these guys, they will have more capex. So the cash conversion will not improve. and they said that they have Alphabet, so no. Microsoft, no. Meta Platforms, no. Novo Nordisk, yes, maybe. Maybe Novo Nordisk will have a lower capex in 2025. Turning to the third leg of our strategy, which we succinctly describe as do nothing. Minimizing the portfolio turnover remains one of our objectives, and we had the turnover of 3%. This is perhaps more helpful to know that we spent just a total amount of 0% of the fund average value in transaction fees. We sold 3 companies and purchased 2. Yeah, that's not a lot of turnover. It is a big year for them, but not a lot of transactions. Come on. Let's continue. Why is this important? You want to minimize the transaction fees so you can have a better performance. Basically, they don't have a performance fee for Fundsmith. They just have a management fee of 1%, which is good. If they outperform, underperform, you just know that you have to pay 1% to let them manage your money. Okay, so 1% management fee. We sold. Oh no, more specific stocks. Congrats if you are still watching this video. That means you really want to know what is happening for Fundsmith, for Terry Smith. We sold our stakes in Diageo, so alcoholic beverages, McCormick. What do they do? And Apple during the year. They built a small position in Apple. I think it was in 2022. I'm not sure, but roughly in 2022, like 2 years ago. And they sold it now. I suspect that they will talk about valuation. What is McCormick? It's a company in the US, $20 billion of market cap. Wow, century old. Has grown to become the leading global manufacturer, marketer, and distributor of spices, herbs, extracts, seasonings, and other flavorings. Okay, quick service restaurants. They sell sauce, herbs, spices. Wow, I have no information about this one. But if you had invested in this company 40 years ago, you would be very happy. Okay. Let's see what they have to say for these companies. The first one is Diageo, which we had owned since inception, has exhibited problems with its new management, shown by a lack of information about its Latin American business, which produced results far worse than the sector in this area. Moreover, we suspect the entire drinks sector is in the early stages of being impacted negatively by weight loss drugs. I mean, they are invested in Brown-Forman, so you will have a negative aspect of weight loss drugs, but they are also invested in Novo Nordisk, which will be a positive, with weight loss drugs. So this is a good hedge. Indeed, it seems likely that the drugs will eventually be used to treat alcoholism, such in their effect on consumption. Okay, we sold McCormick as we had been disappointed by the slow response which the company exhibited in its ability to pass on input cost inflation, so compressing its margins. That is exactly why we want to invest in businesses with high gross margins. You had the table a few minutes ago. This table showing the gross margins. You want to be invested with companies with a lot of margins, a very high gross margin, and maybe this company, McCormick, didn't have such great margins. Together with its exposure to own label competition, which has stiffened as inflation has caused customers to trade down. What is the gross margin of this business? Gross margin of 30%, 40%. So I think for Fundsmith, the average gross margin was 65% compared to McCormick, 38%. So yeah, it drags their whole average gross margin. And this is what happens when you have inflation. If it costs you a lot of money to create your product, your service, you will suffer. Okay, and this is also the reason why you want to invest in asset-light businesses when you are in this inflationary environment. Google, Adobe, this kind of stuff. TPL, Landbridge, they own land. We began purchasing Apple 2 years ago. Yep. at around $150 a share when its PE ratio, price earnings ratio, was below the S&P 500 average, and the growth in the service revenues had somewhat convinced us that the much talked about ecosystem tying its users to the products might really exist. Which is true. I mean, you have an ecosystem for Apple. If my Apple breaks, I will buy it again. And now this computer is linked to this phone that is linked to another computer here. So you have all the data in the cloud. You definitely have an ecosystem and high switching costs. We correctly foresaw a number of reporting periods ahead when sales growth would be lackluster, and so bought a small stake hoping to add to it as the poor sales performance came to pass. We were right about the sales performance. Its sales grew just 2% last year, but wrong about the share price, which rose strongly, placing the shares on a rating about 50% higher than the S&P 500. The PE ratio for Apple right now is 40, so that's high. Apple is not cheap. We were not going to buy more stock, because the stock went up too fast against that background, and it was occupying a place in our portfolio, and so we sold our stake. Yep, that's a perfectly good answer. You bought a stock and you wanted to buy more as it drops, but it took off, and because it takes off really fast, you can't buy more, and finally the valuation is expensive and you find better opportunities, so you sell. Okay. We started purchasing stakes in Atlas Copco and Texas Instrument during this year. Atlas Copco is a Swedish industrial company which makes compressors, vacuum equipment, electrical and pneumatic tools, and which has 3 characteristics which we find attractive. Don't worry, we will go through Growth Focus. I will show you the revenue growth, net income growth later. In case you are a visual person, this might help. So the three characteristics that are attractive: it outsources much of the manufacturing, so making it capital light, which enhances returns. Good. It's highly decentralized. Good. Which over 600 operating entities, which have considerable autonomy in addressing their local market. Yes, there is a controlling stake held by the Wallenberg family vehicle, which should lead to good long-term decision making, since they have been in business for more than a century ago. Okay. Atlas Copco. Atlas, I don't know the company at all, to be honest. Atlas Copco. Come on. Atlas. Come on. Atlas Copco stock. The ticker symbol is ATCO. So let me put ATCO. Cop. Okay, here we go. This is a company in Sweden. Market cap in dollars is $80 billion. Again, that's a big company. And here is the stock price over the past 10 years. So we said that manufacturer, compressor, pneumatic, vacuum pump, industrial power tools. Okay. What about the margins? Gross margins of 40%. Again, it will be a drag on the average gross margin for the fund. Okay. What about the growth? The growth, look at the revenue. The revenue has declined until 2018 and then rebounded. I don't know about this industry, so I have no particular opinion. Net income is this. My guess is during this line in 2018, they sold one of their business, a divestiture of one of their business, and maybe this is the reason why the revenue is growing again. Like, you sell your bad apples and you keep the best segments. Okay. What about the debt? They have some debt, but nothing big. What about the free cash flow? The free cash flow of the business is frankly stable. They generate $2 billion of free cash flow. Is that in billion dollars or in Swedish krona? Let's say it's in billion dollars. Okay, $2 billion for a market cap of $80 billion. That's the price to free cash flow of 40. Price to free cash flow of 30. Let me check the trailing 12 months. Free cash flow is growing, has been growing. Okay, so now the free cash flow has increased. The efficiency is here. Yep, decent business. ROIC of 20%, some dilutions here and there, but nothing big. And they trade at a PE ratio of 30. So, yeah. And price to free cash flow here of 30. So, free cash flow yield, you reverse the formula, that's 3%. Okay. Good enough. Good enough. I don't think I will spend more time on Atlas Copco. Not my kind of investment. And now they also bought Texas Instruments. It's a manufacturer of analog and embedded microprocessors, which go into a wide range of consumer and industrial devices, automobiles, and communications equipment. It is investing ahead of a probable upturn in the semiconductor cycle, yes. Although it is now apparent that there is not one cycle. Demand for GPUs of the sort made by NVIDIA, far from being in a down cycle, has been on a lunar trajectory. And there are clear differences between the cycle for regular automotive chips and chips for electric vehicles, yes, and chips for other appliances, yes, as well as between regions, absolutely. Oh yeah, couldn't agree more. This is a difficult market to be in. However, Texas Instruments has a long history of investing well ahead of upswings in demand and producing handsome returns from it. The key priority for Texas Instruments has always been free cash flow per share. Free cash flow per share, free cash flow per share. They want to grow free cash flow per share over time. This is great when it comes to capital allocation. So they don't want to invest massively in capex. They want to be profitable, be efficient, be growing, and you have this cash conversion. Maybe this is a good way for them, for Fundsmith, to improve their cash conversion. They want to improve their ratio. Maybe Texas is the way. It is also a beneficiary of the onshoring of the semiconductor manufacturing. Okay, Taiwan, China, and this will be a boost thanks to AI. Last year I spent some time in this later. Okay, they will talk about the global market. First, let me show you Texas Instrument. The ticker symbol, if I remember correctly, is TXN. Yes, and the charts are nice. This is a big company, again, $180 billion of market cap. The stock price has been growing over time. The revenue is just growing cyclically, but growing a little bit. Net income is growing substantially. They don't have a debt issue. Efficiency is here. Now you have a temporary bad efficiency because they are investing a lot in capex, so the free cash flow completely dropped. Look at this. They plan to increase their free cash flow per share every year. So free cash flow has gone up and up and up, and boom, in 2023, the free cash flow decreased substantially because of a big capex, big investment. Management says that it's only temporary. They will go back to producing large revenue, but nobody knows. Nobody knows if they will continue. This is the free cash flow over time. Yeah. Maybe you will have an upswing of performance in the future years. Now, I'm almost at the end of the letter. He will talk about the global market, and we can call it a day. Last year, I spent some time in this letter discussing the rise of interest in AI as one of the driving forces behind the rise of most of the Magnificent Seven stocks, especially NVIDIA. This boom hype continued in 2024, but some of its characteristics changed. One is that it may have become more focused. It had been seen as a driver of share prices of companies which we had previously had, such as Adobe and Intuit. Intuit, they do software for accounting. I'm not sure. You will check. Both of which had blotted their copybook with us by engaging in overpriced and seemingly ill-convinced acquisitions or attempted acquisitions. Yeah, I mean, I remember when Adobe, it was in 2022, or maybe before, when they tried to buy out Figma for $20 billion, Adobe and Figma. It was a big deal. It was an overpriced acquisition, but the deal fell apart. They didn't manage to pull this off because of regulation, I think. But yeah, I mean, they tried to do to make a huge mistake here. Both of them significantly underperformed the market in 2024 as reality seemed to dawn on investors that AI may not be of immediate and universal benefit and could actually be detrimental. Yes, my opinion is that AI will boost revenue for a lot of companies, but it will be costly. So in terms of efficiency and margins, I'm not sure that all the companies will benefit. There will be some big winners, like they have the means, they can invest, big capex AI, but you will have companies that will invest massively in AI, that will boost revenue, but that will add a lot of costs, so that will compress your margins and you will be less efficient. And at the end of the day, the stock market is all about earnings per share. So maybe investing in AI will kill your business, kill the efficiency of a business, which is bad. Conversely, this has had the effect of focusing investors' attention on fewer real immediate beneficiaries of the AI boom, such as Nvidia. Yes. During this period, commentators have frequently asked whether the AI boom is the same as the dot-com era and therefore will have a similar ending, like bubble and a bust. In response, I am tempted to quote Mark Twain, "History doesn't repeat itself, but it rhymes." Undoubtedly, some of the AI enthusiasm is hype, as was the dot-com mania, but there are a couple of key differences. They are the leaders, they are growing, they are very big, producing very big earnings, they are very efficient, they don't have a lot of debt. The Magnificent are flooded with cash. They are the clear leader position in key areas, growth market for the future. The leading company in the AI boom, Nvidia, is very profitable, albeit with a history of some downturns, whereas in the dot-com boom, a lot of the share price performance was driven by reference to clicks and eyeballs in the absence of any profits or even revenues. Please read about the dot-com bubble, that's very interesting. People said that valuation didn't matter anymore, and instead of tracking the PE ratio, price earnings ratio, we just look at the price to eyeballs ratio. So if you have a lot of clicks in your website, if you have a lot of visitors of your page, you have a high valuation. I mean, it was completely crazy. Completely crazy. So detached from reality, which is not the case right now. Now people love Nvidia, Meta, Google, Apple, Microsoft, but investors want earnings. We want growth and we want earnings. We don't focus on clicks, eyeballs, etc. Even companies which were to rise phoenix-like from the ashes after the dot-com meltdown, such as Amazon, were not yet profitable. And the rise of so-called passive or index funds. Yeah, this is big. You have a large inflow into passive assets, ETFs. So because this is the way passive index work, I mean, a lot of money will be allocated to the big components of this index. If Apple is 5% of the index, if you have a large inflow into ETFs, Apple will be boosted a little bit by all this inflow. In late 2023, that's the end of the letter. In late 2023, passive investment via index funds exceeded the amount of assets held in active funds for the first time. There are now more than half the AUM. More than half the assets under management. Okay. However, during the dot-com boom, only 10% of AUM was in passive funds. That's a different economy, different world. I don't know how it will end. As ever, we do not always aid understanding with the labels which we sometimes use in investment. Index funds are not truly a passive strategy. There may be no fund manager taking investment decisions, but such index investing is in fact a momentum strategy. Yes, big companies will stay big because you have large inflows. The vast majority of index funds are market capitalization weighted, like the indices on which they are based. The size of holdings in companies in the index fund is based upon their market value compared to the market value of the index. It's all about market cap. The bigger you are, the bigger allocation you will have in the S&P 500. So when there are inflows to index funds to the largest position, the largest position goes to the largest companies, and vice versa where there are outflows. The result is that as money flows out of active funds into index funds, as it has been doing, it drives the performance of the largest companies, which are companies whose shares have already performed well, which is how they became to be the largest companies by market value. Yeah, this is a virtuous cycle. You are big, you stay big. This is a self-reinforcing feedback loop which will operate until it doesn't. For example, were there to be an economic downturn which led to a reduction in tech spending, which is now so large a proportion of overall spending that it cannot be non-cyclical. One area of vulnerability might be the spending on AI, as it is not currently generating much revenue. Not sure of this one, but okay. I trust Terry Smith on this one. Were the largest companies then to produce disappointing results, their share prices are likely to react badly, which will drag down the index performance more than that of those active managers who are underweight in these stocks. Obviously, if markets go up and you have large inflows, if Apple goes up, Nvidia goes up, everything will get lifted. But if Apple goes down for bad results, Nvidia goes down for bad growth, it will drag down the whole market. It's normal. But even if some scenario like this awaits us in the future, what exactly will cause this and when it may occur is difficult, or it's impossible to predict. It's impossible. Which brings me back to the subject of volatility, which was raised at the start of this letter. We don't agree that true volatility is measured by ratios such as the Sharpe or Sortino ratio, which look at the volatility of fund prices or share prices. But they are widely accepted as a measure. Moreover, while investors should rationally focus on volatility in the fundamental value of the businesses they invest and accept higher volatility, if this leads to higher returns, yes. Yeah, you want the highest returns as possible, and if this is caused by volatility, so be it. It is easier said than done. One problem is that it's difficult to remain calm and focus on the fundamental characteristics when the price volatility is sharply negative. Take a stock like Nvidia, which has been a spectacular performer for the past 2 years. The Nvidia share price fell by over 2/3 as recently as 2021, 2022, which is true. Same thing for Meta, same thing for a lot of businesses. Would we or you feel comfortable owning it in such circumstances? Or another question, who, watching this video, who bought Nvidia when it had dropped 60% in 2022? You need a lot of courage and rationality to invest when the stock is cut in half or even more. And if not, might that share price performance cause you to make poor decisions? We have experience owning these sort of stocks, like Meta platforms. As the performance of Meta, yeah, I know it, as the performance of Meta demonstrates. But given how difficult they can be to own, maybe one is enough for our portfolio at any one time. Yeah, they have suffered greatly with a lot of critics for Meta platforms. Maybe they want to play safe now. In 2021, 2022, Meta's stock price fell by 76%. I remember because I bought Meta all the way down. I bought, it dropped more. I bought more, it dropped more. I bought more. It was quite difficult because all the risks were here and you have to keep buying to not regret it after. I did the same thing with Alibaba, and lost my time and lost my money. But for Meta platforms, it worked beautifully. So out of 2 investments, I had a good run for Meta platforms. Good decision. But while we continue to own it despite this, to our current benefit, there are several key differences between the situation of Meta then and Nvidia now. Oh, that's interesting. Meta serves some 3 billion consumers and several million advertisers. Nvidia's demand is dominated by a literal handful of so-called hyperscalers building data centers to handle large language models for AI. Yep, you have a client concentration for Nvidia. So if we enter a recession, fewer people will buy from Nvidia. And the same thing is not, this is not the same situation for Meta platforms. If we enter a recession this year, we will still use Facebook, Instagram, WhatsApp. So, people sometimes ask us whether it is dangerous to own consumer stocks in an economic downturn, to which we reply yes, but it is not as dangerous as to being close to the consumer in these circumstances. If you think the performance of consumer companies is a worry, in a downturn, wait until you see what happens to their suppliers. This is true. Especially the suppliers of capital equipment like factory machinery. A 10% downturn in sales revenues at the consumer companies can translate into cessation of orders from some suppliers. Nvidia supplies capital goods. Its latest generation GPU server sells from about $3 million each, and a significant downturn in demand from its clients who do service consumers would be interesting to watch from a safe distance. Yeah, I agree here. Before its share price fall, Meta was on a PE of 28, whereas Nvidia is currently on a PE ratio of 50. You have a lot of growth priced in for Nvidia, and if you think that Nvidia will continue to grow its earnings in 2025, 2026, the valuation will be a little bit lower. But yeah, that's his point. Valuation is still high and a lot of growth is expected. If growth disappoints for Nvidia, a lot of companies will take a hit. All of which brings me to a reminder of what we are seeking to achieve with this fund, and that is to produce high likelihood of a satisfactory return rather than the chance of a spectacular return, which could be spectacularly good or spectacularly bad. Finally, once more, I wish you Happy New Year. And I received a mail recently, invitation to go to their fund in London. Maybe I will go. I will let you know. This is very interesting. Great letter. I wish them the best for 2025 and 2026. The strategy is working. I'm not very comfortable with the valuation of some of their stocks. I think some of their stocks are quite expensive, and you pay a high price for a business that doesn't grow that fast. But I like the companies they have. I like the philosophy they have, and I think they will do some great stuff in the future. So wish them the best. Great letter, frankly. Amazing, and looking forward to knowing more about what they will buy, what they will do in 2025. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.